Understanding Level 2 Assets, a comprehensive guide. In the world of finance, accurately assessing asset value is crucial for investment decisions, risk management, and regulatory compliance. Among the classifications used to evaluate the fair market value of assets, Level 2 assets play a significant role. This article delves into the intricacies of Level 2 assets, differentiating them from other asset classes, how they are valued, and their importance in the financial landscape. What are Level 2 assets? Level 2 assets are defined as financial assets and liabilities whose fair value can be determined based on observable market data, albeit not on an ongoing basis. Unlike Level 1 assets, which have readily available market prices, Level 2 assets lack consistent market pricing and require more complex evaluation methods. These assets can include corporate bonds and loans, government securities, less liquid or restricted equity securities, certain over-the-counter derivatives. Level 2 assets are often referred to as mark-to-model assets because their valuation relies on models or methodologies that utilize observable data from the market, such as prices for similar assets or liabilities and market interest rates. The hierarchy of asset valuation. In accordance with the Financial Accounting Standards Board, FASB, 157, assets are classified into 3 levels based on the ease of their valuation. 1. Level 1, assets with prices available from active markets, e.g., publicly traded stocks. 2. Level 2, assets with observable inputs derived from recent transactions for similar or identical assets. 3. Level 3, assets without observable market data relying on internal models or estimates, often resulting in subjective valuations. This classification aids in enhancing transparency for investors and stakeholders regarding how a company's assets are valued. Importance of Level 2 assets. Level 2 assets are commonly held by financial institutions such as private equity firms, managing diverse portfolios. They often invest in illiquid assets necessitating robust valuation methodologies. Insurance companies, these firms rely heavily on asset valuations for policy underwriting and financial reporting. Investment banks, valuing complex securities and derivatives, investment banks often engage extensively with Level 2 assets. By understanding Level 2 assets, investors can better assess risks and returns associated with their portfolios. Valuation methodologies for Level 2 assets. Valuing Level 2 assets is a complex process. Financial institutions typically employ models that use observable inputs like interest rates, the cost associated with borrowing, vital in assessing asset value. Default rates, predicting the likelihood of borrower default, which influences securities pricing. Yield curves, reflecting the interest rate environment. Yield curves are instrumental in pricing bonds and loans. Example, interest rate swaps. An interest rate swap is a prime example of a Level 2 asset. In this financial agreement, 2 parties exchange future interest payments based on a specified principal amount. The valuation of an interest rate swap can be determined by analyzing the expected future interest rates as well as current market conditions. Observable versus unobservable inputs. Recognizing whether an asset is classified as Level 2 or Level 3 is pertinent, particularly since different disclosure requirements exist for each category. Here are critical distinctions. Observable inputs, Level 2. Support from real market transactions. Prices that are publicly available. Regular updates and disclosures. Unobservable inputs, Level 3. Lack of market transaction support. Internal estimates without public benchmarks. The classification impacts the level of transparency in financial reporting and can affect investor sentiment and market stability. Conclusion. Level 2 assets serve as a critical component in the financial valuation landscape, bridging the gap between liquid market assets and those that require speculative pricing models. Their valuation methods incorporate observable market data, making them more reliable than Level 3 assets but still presenting unique challenges for accurate assessment. Recognizing the nuances of Level 2 assets not only aids investors and analysts in making informed decisions but also contributes to a deeper understanding of financial reports and the overall health of firms and investment vehicles. As markets evolve, grasping the fundamentals of Level 2 assets will continue to be paramount for strategic investing and economic analysis.